Well, howdy there, folks. Welcome into this four videos up here for me to react to. Sofi's Liz Young is flipping. You gotta be flipping my flapjacks. There's still room for a rally to continue. Oh, this should be very interesting. Second video we'll react to here is this one. What's priced in for rate cuts next year? We're gonna listen to Mohamed El-Erian and kind of hear his perspective on what's going on here, what he expects for the market overall, and I want to share kind of my opinions and perspectives on that one. Then the professor, Jeremy Siegel. We're going to listen to what he has to say in regards to the Fed, lowering rates, 2024 predictions, all those sorts of things. And then last video up here is we're going to listen to this gentleman react to this one. Stocks will likely continue their upward momentum into year end. So yeah, whole bunch to go through. Appreciate you guys joining me. Thank you for being subscribed, folks. New all-time high subscribers. I think we're at 36,600 plus subscribers now. So appreciate y'all being here. Also, two things to let you know. 3 days away from the massive Black Friday sale. $62, you get access to the Become Master Stock Market course. Moves I'm making in the market. See exactly how I build a portfolio over time. It's 3 days away, folks. If you want access to that, it's a one-day sale. Black Friday only. If you want access to that, check out the pinned comment, enter in your info, and we'll send it over via email or text on Black Friday. Okay, it's a one-day sale. So holy smokers, ain't no jokers. And secondly, tomorrow's NVIDIA's earnings, I will be live streaming NVIDIA's earnings on Twitch. I'm going to be live streaming today on Twitch as well. But that's going to be crazy tomorrow, obviously, with NVIDIA earnings after the bell. So you definitely want to join me for that. If you haven't already followed me on Twitch and you're interested, then check out the second pinned comment down there. The first pinned comment will be the Black Friday deal, and then the second one will be Twitch. Alrighty, guys, let's get into this.
The Q's now highest level since January of 22. To Josh's point about mega cap, I'm looking at my screen here, and I've got every one but one in the green, and nicely so today.
Yeah, well, think about what pressured those stocks from the end of July into August and September. It was higher rates. It was a resurgence in inflation. Both of those things have all but been taken off the table in the last couple weeks. So I think it makes sense that there's a run here. Also, to Josh's point, absent some exogenous shock or absent some sort of data that none of us were expecting, I do think there's still room for a rally to continue. And that's coming from somebody who's been pretty cautious all year. But the reality
Yes, this is a huge statement. Literally, for the past year, we've reacted to so many Sofi Liz Young videos over the past, I would say, 12 months. And she always comes across as bearish or at least cautious. Like, cautious is like good for her. So for her to say there's more room for a rally just kind of speaks to the volume of some of these Wall Streeters starting to flip, because that is insanely surprising, folks.
Lower rates and the idea of a soft landing still.
By the way, let me see how my stocks are doing today. I haven't really gotten a chance to see how my stocks are doing today. Let's take a peek. Alrighty, so looks like Honest, Fubo, Foot Locker having really good days, so the smalls are flying. Palantir, look at Palantir tearing it up, 2150 here today. Revolve making a huge move. That's another smallie, right? Shopify making a nice move. PayPal, Meta. Looks like as far as downers today, we got the Planet that's down big, but that one seems to come back toward the end of the trading day, so I wouldn't be surprised if that one recovers massively. Elf's down about 2% here today. Yeah, not much for Red Dead Redemption. Overall, it's a very good day. Probably an up $10,000 to $20,000 type day in the public count. I would say somewhere in there roughly, 10K maybe at the low range, but probably closer to 20K, if not a little over 20K there.
Possible, and if not priced into the market, unless there's something standing in its way, which I don't think we're going to get really nervous about from a macroeconomic point until early next year. The rally can keep going, and we probably grind through this for a while.
All right, so let's do Microsoft and get that story going, Joe, because it's up 1.6%, $375. By now, everybody knows the story. They hire Sam Altman to lead their new AI team. All this drama at OpenAI, now what some are calling chaos, and what that's all going to mean. You just want to scratch the surface first with, as a Microsoft shareholder, what you're thinking about, and then we'll present some of the arguments around what this really means.
It's remarkable because a $13 billion investment, which gives you 49% of the company, you actually get more than you are getting with that investment with the intellectual capital that you're acquiring here with Sam Altman and others joining. I suspect there'll be more to follow from OpenAI. This is certainly something that will benefit Microsoft. It's also going to benefit Meta. And I think that's one of the reasons why Meta is at its highest level since December of 2021. Let's remember that OpenAI has 92% of Fortune 500 companies, 2 million customers. Well, a lot of those customers right now, Scott, are looking elsewhere in terms of software, and Meta can offer with its LLM, its large language model, Llama, a clear alternative. So Meta's benefiting there as well. This is obviously something, as I said, that speaks strongly to Microsoft. And it's a reminder. It's a reminder what this year has been about. What this year has been about with generative AI and the contribution that it has had to the overall market. And it's the reason why the NASDAQ 100 today is at its highest level.
So Meta's my biggest position in the public account in how much have I priced in AI related things into, what I think Meta stock can do over the next few years. And the answer to that is zero. It's all upside. So if Meta can make bank off AI, like that's all just a straight call option is basically what I would say in regards to Meta shares. Like I'm staying invested in Meta, and I believe that stock's going to 600 over the next few years based upon just kind of what they got going on with FB, with IG, with WhatsApp, monetization there. So when we're talking about things like Oculus or Meta Quest 3, I should call it, right? When we're talking about things like AI related stuff, that's all just extra, man. That's all just extra stuff there. And so if Meta's a massive player in AI over time, I mean, whoo-wee.
On an intraday basis.
So I'll come back to you. So they have 49% of OpenAI, which was said to be valued at $86 billion. What's it worth now? You can't answer the question anymore because you don't know with the chaos and the so-called brain drain and all of this turmoil. So what is that interest really worth? Is it the coup for Microsoft that it's being portrayed? Now, Dan Ives would suggest absolutely it is. He calls this a World Series of poker move for the ages. Those are his words. Quote, we view Microsoft now even in a stronger position from an AI perspective with Altman and Brockman at Microsoft running AI.
I completely agree with that. And I think the interesting thing about it is, look, they were thinking of selling shares in October. A lot of employee shares were going to be sold. Valuation, as you said, 86 billion, somewhere around 80 to 90 billion. So obviously, I think the company right now is in, I don't want to use the word perilous, but it is certainly in a injured condition relative to where it was previously. There was, back to 2018 in the initial stages, you had Peter Thiel, you had Reid Hoffman, and you had Elon Musk that were behind funding this company. And one of the critical things that they did at that time was they took the chief scientist from Alphabet and they brought him over. Why did they do that? Because they wanted to slow down Alphabet's AI intentions. So I think now with Microsoft in control of that intellectual capital, I think you also have to ask yourself, what's the derivative effect on Alphabet? Is Alphabet in a better or a worse position because you have Altman and Brookman over at Microsoft?
That's a good point. That's a good point. And that story needs to play out there. All right, next one up here, Mohamed El-Erian. What is his opinions on where we're headed here?
Narrative ping pong about the type of economic landing that market analysts are expecting is far from over. Let's bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and President of Queens College at Cambridge University. I was wondering whether it was over. I read a piece that said you can expect stocks to keep getting a pretty good bid, Mohamed, as people come to the conclusion that the soft landing dream is actually playing out. And it's always been nothing but a dream in the past. I don't know if they've ever really done it. People are starting to think that it in fact, is a reality. Do you doubt that?
So certainly that's where the market is going. The market believes that because we're heading for a soft landing, we will see not only the end of the hiking cycle, that's done, but we're also going to see aggressive cuts next year, and that will be consistent with growth not suffering in any material way. So that's where the market is. And I'm saying this not just on what's happened in the Treasury complex, but look at corporate spreads, look at other indications. That's where they are. I think the market is absolutely correct in pricing in that the Fed is done. Beyond that, however, there are significant uncertainties, Joe. And I think that what's priced in right now for cuts next year is probably too aggressive.
Right. So
that's possible.
We may not see another hike.
That's possible. I mean, there's literally a possibility we get no cuts in 2024. Like if the economy is really good and actually strengthens in 24, which I think there's a decent probability of that, with real wages getting in a better place, like the Fed won't lower rates the whole dang year. The Fed's not going to really lower until they really get some sort of economic weakness that makes them say, okay, unemployment's 4.3% and it keeps going up or something like that, right? That's what it would have to happen.
We should not see another hike. I put it stronger. We should not see another hike. The Fed should, at this point, wait to see what the lagged effects are of what it's done. And also, importantly, we need to understand better two things that we don't have a handle on. What is the new neutral level of interest rate? And what are the disinflationary dynamics in the service sector? There's big uncertainties about both these issues, uncertainties that the markets has brushed aside, but I think the Fed is aware of those uncertainties.
The interest rate environment and the absolute price levels are still not great for consumers, Mohamed. How long can we count on? I mean, we may be seeing a little softness, but still hanging in there. What about 2024?
So it depends what you're consuming. The Journal has a nice piece today that shows you that the most popular gifts that we tend to give at Christmas time, their prices are actually lower than they were a year ago. So there's a small segment of the goods sector that has not just had disinflation, it has had negative inflation. That's the good news. But the service sector, us traveling for Thanksgiving, us doing all the other stuff we like to do, eating out, etc., that's still subject to high inflation. It just shows you the dynamics are very different between the goods sector and the service sector.
I was going to ask you whether I should still send you a Zach Wilson jersey. I think I can get those fairly cheap, Mohamed.
Yeah, Joe, I don't know what to say. I mean, I don't know what to say. Well, he was benched, so that should be a message to him. But what I worry about most, Joe, if you want to go towards the Jets, is that our incredible defense is going to start being really fragile because they can't stay on the field that long. We need our offense to produce. And our offense hasn't produced.
I immediately when
all right, okay. I'm not going to listen to these guys talk sports because I'm not convinced they know much about sports. But anyways, next up here, the Professor Jeremy Siegel. What's the Fed up to?
Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. It's not a Rorschach, I don't think, Jeremy, but would you say everything?
Watching those guys talk sports is kind of like watching Stephen A. and Skip Bayless talk about the stock market. Is kind of like, okay, that's about enough of that.
You've been saying for the last 6 months, we're kind of seeing a lot of it either be exactly true or at least partially true.
Well, I remember on January 1st, I said we're going to have a 10 to 15% gain. I think we're slightly above that on the S&P. Of course, those Magnificent Seven have been a big contribution to that. But Joe, I mean, I only have one worry for next year, and otherwise I think it would be an absolutely great year, and that is that the Fed will be as stubborn in lowering rates if they have to as they were in raising rates, being so very late to the game and causing the inflation. I mean, let's face it, last week's data was weak. I mean, people talk about coming in for a soft landing. We're coming in for a landing. It's not guaranteed to be soft, not yet. Now, I'm not calling for a recession. I just want the Fed to be flexible. I was a little disturbed when, Jay Powell said at the last conference, we're not even talking about lowering rates. I think they should be talking about, not necessarily doing it right away, but, the data is looking very different than it just did 3 or 4 weeks ago. Lower inflation, but also a lower level of economic activity that is trending downward.
But you had been talking all along since January, as you said, about that the money supply was actually contracting more quickly than you thought, that the conditions were tighter than they looked, that inflation was being overstated by certain components, and it was actually lower than it appeared. So all those things seem to have been borne out as more data has come out.
Yeah, and really, I mean, we've had no growth in money supply over 2 years. You need about a 5% growth in that important liquidity measure to get a growing economy with 2% inflation. I'm a little worried. He better not go back to the narrative of the 70s. Oh, stop and go. We got to absolutely kill inflation. It's very, very different. In the 1970s, Burns pumped money in at 10% a year without fail. Here, Powell stopped it. It started going down. And of course, I became very alarmed. Then he eased up a little bit. It began to rise. Last 2 months, declining again. And now when I look at that real economic data, I said, he's got to be thinking with the lower rates, he'll get that credit going up again. We could have a real great year for 2024.
Well, would there be any reason to start cutting rates if we...
So a risk is, let's say the Federal Reserve cut rates in 2024. While the economy is actually strengthening because real wages are getting in a much better place, so the consumer's in a much better place, right? That could create potentially a bad inflationary environment in 2025 where we're above the 2% and maybe we're in the 3s and 4s in 2025 if we had a much strengthening economy. On top of that, you have a Fed lowering rates, and so obviously there's a lot more loans and people buying cars and homes and all those sorts of things. So that is kind of the risk, right? Is a potential resurgence in inflation, especially if you haven't completely killed it. But I do think we're going to likely get the job done. It's just usually it doesn't make sense to cut rates in any substantial way until you're really starting to see some like real economic weakness. That's just something to kind of keep in mind. Because, I'm sure they don't want to go through the 70s and then have to come through again and start raising rates in, let's say, 2025 or something like that, right? That would be no bueno.
Soft landing, Jeremy, why not? It seems like we normalized where rates used to be prior to the financial crisis. You think we should stay here, or are we too tight right now?
Well, I think we should uninvert the yield curve. And basically, it looks to me that we had peaked at 5% on that long end. Now we're 4.5%. Well, that means that we have to start moving down on Fed funds. I mean, it's not going to uninvert by the long bond going up to 5.5 and 6. I mean, some people talked about that a while ago. No, if we're going to uninvert it, we're going to have to bring it. We're going to have to start bringing it down. And just if we have very little inflation, 5.5% Fed funds is a very punishing real rate. Even with the promise of AI and everything else, it'll be hard to overcome that. Look what's happened in the home building. Now we got good housing starts, but home building sentiment has collapsed over the last 4 months, and that is another area of softness you have to consider going forward. So, given inflation is licked, in my opinion, and I've said that for a long time, as you said, real rates are extremely high. With the jobless claims going up, by the way, we had a 2-year high, and in continuing claims, I think it's time to uninvert that curve, which does mean start talking about lowering rates.
Interesting. Yeah, I mean, I think it makes the most sense for the Fed to start at least considering, talking about it. I think probably first quarter, second quarter of 2024, right? And then once again, in terms of actually doing it, you got to make sure inflation's where you need it to be, and you also got to make sure the economy's starting to weaken, to at least a decent extent. All right, next up here, stocks will likely continue their upward momentum into year end.
You're overweight on equities. All year long, you've been saying you don't see recession coming up this year. It looks like you were right. But now, as we see this rally in the markets, what are you expecting this week as we go into a holiday shortened week and also a period of time where we have 2 more inflation reports and also a Fed meeting?
Yeah, Frank, I mean, we have been, and I'll tell you, a year ago, we were saying we thought the market would do pretty well and avoid a recession. It wasn't popular. We've had these pullbacks this year. We've had this volatility. But this week specifically, it is what it is. It's a holiday week. We wouldn't be surprised at all if a little upward bias is what you tend to see. Low volume, low news. But the truth, again, and we talked a month ago about this, we expected a late October low like you tend to see. Pre-election years are usually pretty strong. We've talked about the strong consumer. We've seen, a better economy, I think, than most people think. I mean, Frank, we're supposed to have record earnings next year, and we think that's very, very possible as well. That's probably not a bad thing. I mean, the concerns are there, but one final comment. The New York Fed does a survey of consumers, right? We know the inflation consumers. Well, you also look at what do you think of the stock market, okay? The recent data that the New York Fed just did showed that consumers are the most bearish they've been on the stock market all year. Okay, so there's still a lot of negativity. And when you have a strong November, you actually tend to have a pretty strong December. So
damn, man, that's one of the things that makes me feel so freaking, actually surprisingly bullish over time here. I look out there and I'm just like seeing how many people want nothing to do with the stock market. I'm talking about, just regular folks that, were so like, gotta get in the market in 2021, right? And just like now, no one has interest. I talk to friends and just different people like, hey, you buying this stock? Or, were you buying dip last year? And just like almost everybody has no interest. And the last time it was really like that was around 2009 through about 2014. 2009 through 2014, tremendous time in the market. That's when I had my first big come up in life, was 2009 through 2014. And I got to $200,000 in stocks. And back then, you couldn't talk to people. I try to talk to people all the time and get them in the market and teach them what I know. No one was freaking interested. It was when we had a presidential change and some more people got like bullish on the market because they felt like, their guy was in. Then we started to see some momentum, and then we had a blow-off top situation, obviously, in Rona, right, in 2021, and everybody wanted to buy stocks. And I'm just looking out there, I'm like, where's everybody at? No one's freaking here, and except for a few people, and like we're making all the money, and it's just like it's back to the old days, man. It's back to the old days. It's like underground kings now at this point in time. So interesting how it works, isn't it?
We're gonna be a little higher before this year's done.
You're packing a lot in there, Ryan. So I also want to get to some research that you sent and some research that your firm's doing. So right now, we're just about a year away from the 2024 presidential election. And historically, you say that sets us up for a year-end rally and a rally going into that election. We're going to show the chart you sent us in just a second. So give us a sense. That's the historicals right there. Are we set up for that similar rally this year? A very different situation. Not only are we coming out of the pandemic, but we're also having a rally this year fueled by AI.
Yeah, you're right. I mean, there's all these different things that are fueling it. I already talked about some of the negative sentiment, but we do think it's possible. And when I was on with you a month ago, we said we need something to spark this. Let's be honest, Frank, it's probably what the Fed is saying, right? What the Fed is saying. We think the Fed is done. We've been on record saying the Fed is done. We needed to see shelter starting to come back down. I think that last CPI print showed shelter is finally starting to come down. Shelter and cars make up more than half of core CPI. Used car prices have been down 14 months in a row, year over year, according to Manheim data. And now we've got shelter coming back. So that's the spark. And then also you've got AI, the excitement there. But just the truth is earnings, once again, came in stronger. We had earnings recession. We had negative earnings 3 quarters in a row. That ended. And next year, we expect to see positive earnings, which should continue to drive this year, but also into next year, which is going to be a very interesting election year.
All right, before we get to next year, Ryan, I do want to talk to you about something you just mentioned, AI and all the excitement. I think Microsoft and maybe OpenAI have more excitement than they planned on, with Sam Altman and Brockman both being moved out of the company, then taking jobs at Microsoft. Give us a sense. Does this change your sense of the AI arms race, if you will? Does Microsoft, is it still in your mind a leader? Obviously, a lot of the companies involved here are very influential to the market. We're talking Google, Amazon, and Microsoft.
Well, I mean, sure, Microsoft is absolutely still a leader. I mean, the truth, again, though, is a lot of these companies have been strong. I mean, I was looking year to date. Tech's up like 45% year to date total return, right? Communication services not far off. So it's not just all about the Magnificent Seven, in my opinion, to kind of answer this. We know those big groups have been there. We've seen a lot more participation, but just to AI, history doesn't repeat itself. It often rhymes, as Mark Twain has said many times. Keep this real quick. Mid-90s, the internet was coming. Now we've got AI coming, right? Also, mid-90s had high productivity, frank. We are finally seeing high productivity in our country for the first time in a long time.
Yep.
Those are positive things to us that say, listen, are we in a mid-90 scenario? I'm not
100%.
sure, but there's some things to say maybe we could be, which is good for investors.
And companies are running lean and mean now at this point in time, which is also pretty bullish overall. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. Massive sale coming up here, Black Friday. It's a one-day sale. Access to that. Pin comment down there, enter your info. We'll send it over. And then if you want to follow me on Twitch, that'll be second pin comment. Much love and have a great day.